Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And we're back with you again this afternoon for our weekly wrap up. Graham, I understand it's been a pretty volatile week again. What can you shed some light on as far as how things were in the market?
Yeah, as we're moving into the summer, I'm thinking about roller coasters and amusement parks, and it feels like it was one, right?
Right.
The Federal Reserve met last week, and their job is to, try to regulate interest rates and trying to manage the growth of the economy so it doesn't underheat or it doesn't undergrow, right? So they raised interest rates, Fed funds rates, 50 basis points, and basically took off the table the 75 basis points. And I think the market really used that as a cue to really rally off of. The Dow was up over 900 odd points. But it didn't take a day later that the market decided to think about that a little bit further and pull back roughly 1,000 odd points. And then we had a little more weakness as we closed out the week. So basically, there's a lot of drama, a lot of up and down, like a coaster ride, to really not go anywhere. I mean, the Russell, the NASDAQ was off maybe about 1.5% for the week. And we saw, basically the S&P basically flat for the week. But I do want to point out, and I don't want this to be missed on the call, I know this is unnerving. And I know it's unsettling to go through these times. No one enjoys going through these market pullbacks, corrections, possible bear markets across all the indices. But as we know, and I didn't say as we know, this is a part of investing. You got to take the good in the bad. Keep in mind, for our listeners and our clients already know that, hey, listen, the S&P averaged about 25% of the last 3 years. 15% on average over the last 10. So yeah, it's not always comfortable, but reasonable to expect a pause to digest so we can regroup and hopefully sooner than later rally off of. One stat here, Stacy, and I'll get into some more things from last week, is that, the market's gone through 26 corrections since World War II, and the average decline is about 13.7%. Now, corrections are 10%. Roughly, but 20% or more, which are called bear markets, all right? And that's where the NASDAQ's in, the small caps in, but not the Dow or S&P yet. We've had about 12 of those. It could get a little worse because the average decline is about 32.5%. Now, the average time that we stay in these periods are anywhere from 4 months to 6 odd months, maybe 11 months. So they're not long in terms of your or our viewers or our clients' time horizons, in terms of probably a goal a couple years out or retirement 10, 20, 40 years out, but it's still going to be something that we're just going to have to work through. So I just want to let everyone know, listen, we're with you. We know it's uncomfortable. We know it's not fun, but we'll get through this. We've seen it before. We'll see it again, but it could get a little worse before it gets better. But let me wrap up some last couple other things that we saw from last week. We really saw some inflation spike internationally. Saw the UK really increase their rates even further. Their inflation is right now around 10%, ours at 8.5%. We are hoping that we'll see a moderation in our inflation rate as we're coming into those numbers reported in a couple of weeks. We'll just have to see. But we're hoping that we're going to see maybe a consumer kind of tamp down their demand a little bit, maybe supply chains open up a little bit, that hopefully would take some pressure off inflation and take some of the angst or anxiety out of the market a little bit. We'll just have to wait and see.
Okay. Well, I understand the interest rates for mortgages are rising. What do you see happening there as far as consumers? Do you think they're going to pull back on looking at houses?
Well, they could. If you think about it, us as consumers, we're getting hit from all angles, right? We pull
Right.
in to get gas in a car and, look where that's gone. We're getting groceries and that's up 13, 20, 30%. The mortgage rate is up almost 100% from some of the lows. We're trading at about 5.6 odd percent on a 30-year as of last week. That's a far cry from 2.6, 2.7, 2.8%.
Right.
Heck, even 3% that we saw just a couple months ago or 6 months ago. So I have to believe, and I'm not alone in this, that, yeah, I think the temperament to buy at any cost is going to pull back a little bit. That would not necessarily be a bad thing to kind of bring that demand down, hopefully bring inflation down a little bit.
Okay. Well, do you see the market presenting any good values, even with the volatility, maybe some opportunities for investors?
Yeah, thank you, Stacy. I think that's a great question, and the answer is absolutely. Now you got to think about your time horizon and your risk tolerance, right?
Right.
But think about this. I mean, if your time horizon is more than a year out, your time horizon is 5, 10, 15, 20, 30, 40 plus years, which most of us are, there's tremendous opportunities. Always look for great quality companies that have strong earnings, strong products, strong service, proven products and service, hopefully a dividend, good profit margins that can handle cost of goods going up and down. And maybe they can transfer that cost to the consumer a little bit so they can keep their margins. That's where I'm going at with that. Maybe strong share buybacks, dividends. You focus on those areas outside of the areas just outperforming right now, like commodities and materials. And I think you could have some long-term value out there. And that's in the technology area. That's getting hit the most right now. That's in the growth area. So I do want to make a point to our viewers, and I'm glad you brought it up. It's not an all or in market. It's not getting out and trying to time it, getting back in. We know that doesn't work. It's not all value or all growth. I think it's a balanced portfolio of high quality investments, diversified with a plan in place, and you have some time horizon. But one last thing I do want to make on that, if you need funds in the next 3 months, 6 months, 1 year for income, or a goal, or a water heater, or a roof, or college, or a car, whatever it might be, I'd rather see you set that in a very conservative savings account, money market account. Just don't take the risk of the market right now. I don't know if that's really on our side with the volatility and the question marks, with inflation, the markets, valuations, and the war.
Well, that makes sense. It's always good to be prepared. And it's also a good reminder that there are opportunities for investors as well. So
Absolutely.
thank you so much for this information. And thank you to our viewers for watching and joining us today. We look forward to seeing you again next week for our next weekly wrap up. Thanks so much.
Take care.